few things out of the economic calendar this week, but you can be certain that both investors and traders are nervously going to be waiting updates on something that isn't even on the economic calendar. That's right. It has to do with the debt ceiling. We're going to get to that towards the end of this video. But for now, as always, let's go ahead and start off with some of the more recent events. I'm going to start off with there was quite a bit of Fed speak to digest. I want to put it this way when it comes to Fed doves. In the current phase, they have two things that they can rely on. First is the banking crisis causing credit conditions to tighten. So that means that it kind of does their work for them in terms of not having to raise rates. Fed Chairman Powell did point out to that. And the second thing has to do with the lag effect when it comes to monetary policy. In the past, maybe year to year and a half, in some cases, only 9 months to a year, especially if the proxy fund rate is a bit higher. So in this case, we did hear from Fed's Jefferson, did talk about inflation being too high, citing the lag effect. I do like what Bullard had to say. He said slow progress on inflation may warrant taking out some insurance by raising rates somewhat to make sure that we really do get inflation under control. Wants to be on the safe side there. I don't think markets like that, but it is an interesting take. You got Logan on the upcoming data, which we got PCE price index this Friday, and then but those are figures for April, and then you got the figures for CPI figures for the month of May, which are going to be released before the Federal Reserve's monetary policy announcement mid-June. So that's going to be crucial. I mean, we do have the NFP report as well, but these are going to be the crucial items between now and the next Fed meeting on whether they can skip a meeting. Didn't say whether or not they're going to completely pause. They're always keeping that open in terms of raising rates afterwards. Inflation does, for whatever reason, manage to pick up, and Kashgar over the weekend open to the idea of pausing in June and moving a little bit more slowly from here on out. Market pricing, by the way, still heavy majority, I should say, nearly fully priced in when it comes to being on pause. But interestingly enough, the minority has remained quite firm over the next few meetings. So that opportunity can always open up, of course, depending on the economic data, given that they are going to be data dependent in the current phase, and noting, of course, any developments when it comes to banking or comes to the economy in general. But for the time being, in terms, if it keeps that option open in terms of rate hikes or, over the next few meetings, that kind of has pushed out a rate cut from before it was kind of majority pricing in September, now kind of in the middle in terms of whether or not it'll happen in November, and kind of pushing out towards December, which is kind of what the Fed wants to see. They don't want to see any, they're saying that they're not anticipating any rate cuts this year. So that's kind of where we stand when it comes to the market over there. And just let's go ahead and start off with the week ahead then. In terms of the U.S., again, I'm going to get to the debt ceiling at the end, but you got preliminary PMIs tomorrow out of S&P Global. That's going to be for manufacturing expectations 50, services 52.6. Long story short, manufacturing going to remain tested or kind of potentially flirt with contraction, and if you got services that's been healthier but still very much close to the middle. You're also going to have on Wednesday minutes from the latest FOMC meeting. Now, given markets have been consistently trying to price pausing out of the U.S. Federal Reserve, they're obviously going to be looking for any hints of that. That's going to reinforce their narrative, even if that narrative doesn't support what the markets are pricing in terms of rate cuts. And then on Thursday, you got preliminary GDP, which I don't think is going to be as impacting because the serious miss was advanced GDP. This is first quarter GDP figures, gross domestic product. And in the advanced GDP estimate, it was 1.1%, which was roughly half the 2% expectations at the time. So I think the big miss has already happened as long as it stays positive. And even Atlanta Fed's GDP now estimate for this quarter positive. So as long as it doesn't surprise too much to the downside, I don't think it's going to remain that much of a worry. And then of course you got the usual weekly claims on Thursday, which last week below estimates, above 200K though, continuous claims though falling back just beneath the 1.8 million handle. And if there was on Friday, PCE price index, this is going to be a crucial one. Month-on-month expectations, both headline and core, 0.4%, higher than what the Fed would want in terms of looking, translating that into year-on-year moves. But year-on-year reading should drop. Headline, core, as always, that's the problem child these days, proving to be a bit stickier. You got personal income and spending, should expect to show growth, and then U of M's revised figures, where I'd really note. I mean, I know the number has been bit depressed when it comes to consumer sentiment at levels usually reserved for a crisis. In this case, the expectation is that I would like to look at least a 12-month horizon when it comes to consumer inflation expectations, just because if it remains very high, and it was high last time around, that's something the Fed does not want to see. What about globally? Well, we had this morning the People's Bank of China's policy decision, rates on hold. I'm actually not in the camp where I'm anticipating too much easing unless something really bad happens. And the reason why is because they have to know capital outflows. The yuan USDCNY going above the 7 level, last I checked. And the issue, of course, there is if they're worried about capital outflows, you don't want yield differentials, at least in nominal terms, to be very high between that of the US and China. So that's something I think to keep in mind in the sense that it's going to be a little bit difficult for them to reduce rates, even if from a pricing point of view, CPI and especially producer prices, right, the latest readings that we saw definitely gives them room to go ahead for further easing. I don't think that it's going to be as easy for them to do that if they're noting capital outflows in the current phase. But otherwise, that was this morning. Tomorrow we're going to get preliminary PMIs from the rest. So I already talked about the U.S., but the same theme is there. Tested manufacturing ingredients below below 50 actually when it comes to some parts of the Eurozone, but expansionary when it comes to services. On Wednesday, we're going to get the RBNZ, Reserve Bank of New Zealand's fully priced in rate hike to 25 basis points to 5.5%. There is a significant minority going for 5.75, but it doesn't happen this time. They're expecting that it's going to happen at their next meeting. And of course, when it comes to UK pricing data, which headline has been quite sticky, not just the core, but headline is expected to experience a decent drop, well below 10%. But the core, as always, problem child, it's going to remain sticky, and it's going to be much, much harder to drop. Retail sales, that's going to be on Friday. Month on month, regardless of what's happening there, we're seeing year on year hasn't been nice readings on the retail front out of the UK. And on Friday, we've got also pricing data out of Japan. This is going to be Tokyo pricing data for the month of May, because last Friday we had the April figures. That was national CPI, but it was for the month of April. So this is always going to give us a better idea of what to expect. And those numbers, by the way, headline, core, you're removing food and then removing food and energy, all of them hotter than expected, all of them above the BOJ's target. How did the policymakers respond? By saying that there's going to be continuity when it comes to monetary easing. So there's still going to be an ultra easing mode, and that kind of is pushing out the date where analysts were expecting that there might be some sort of at least tweak when it comes to the yield curve control from, say, 50 basis points to something ideally a bit higher than that. That's obviously been pushed out just because of what we've been hearing from them on that regard, even if CPI figures have remained relatively high. So that's when it comes to that, and it's important. Then let's go ahead and start with the debt ceiling. I'm not going to go ahead and talk too much about the difference between budget and debt ceiling, just long story short, because a lot of times people are going, well, why are they talking about spending and taxes and cost cutting and all that? Well, I thought they did with the budget. Long story short, with the budget, you're agreeing on what you're going to spend, how you're going to raise money, all that kind of stuff, revenue and costs, and all that fun stuff. But if there is a deficit, and there usually is a deficit, right? If there is a deficit, at the end of the day, you got to fund that. And when you reach the ceiling, which in this case for the US, $31.4 trillion, that means that you have to raise the debt ceiling. So basically, you've agreed on the budget, but then when you go, well, I'm borrowing beyond what we were allowed to beyond the ceiling, then I got to go ahead and there has to be an agreement again to raise that debt ceiling. Now, when exactly is Treasury expected to run out of cash? It was supposed to be around the start of June, could be around mid-June, depending on the situation. I do think there's a bit of this, the Treasury Secretary trying to push, saying, okay, it's the beginning of June, so you can really push the lawmakers to think like, look, guys, this is quite urgent. Get it sorted now, because otherwise they're going to wait till the last minute, right? It's kind of like telling someone, if your research paper in high school is due, on the first of the month, and it turns out it's really the middle of the month. I once had that happen to me in high school, and everyone's like working really hard to get it out by the first, and then you had those few guys that are kind of late and stuff, but technically it was the 15th, right? So then they're like, oh, well, you actually have 2 weeks, but we had to play with you a little bit there. So maybe there's a little bit of that saying, okay, let's get them to try and get this deal done now, so we don't have to wait till the last minute, which might be around mid-June. So it's kind of a situation of, don't worry if they're worried, but worry if they're not publicly. But this is the situation currently in the early to mid-June. And long story short is, if it gets to the point where for whatever reason no deal is done, or takes, let's say, no deal is done until, say, mid-July, that means that in the meantime, the Treasury obviously has to prioritize. It does have money coming in, but the payments that they have to make are obviously going to be larger. And usually the priority is between two things. It's either, on the one hand, you've got servicing that massive government debt, whether it's maturity, payments, things like that. And on the other hand, you've got the government programs, especially the big ones like Medicare, Medicaid, and Social Security. Not going to go into all those details, but long story short, they're going to have to prioritize. And the thing is that if, for whatever reason, they're not able to make their payments on the debt, that means that you have a default, but it's not going to be, there is no cross default when it comes to the Treasury market. So it's not going to be on the whole $24 trillion Treasury market. It's going to be on those that where you have, when maturity occurs within that period. And that's the reason why some of the investors have been shifting to more longer term debt, and those that are opportune going, well, wait a minute, but the yields on the 1 month T-bills are amazing right now, and I think that there's going to be a deal. So if they're so high, let me go ahead. They see an opportunity to say, okay, let me go ahead and buy it up. So those that are certain that there's going to be a deal, they don't mind taking that risk, and they'll go ahead and buy it up even with that risk premium. And those that are much more risk averse, saying, you know what, I'm going to avoid anything that's going to mature anytime soon. Let me go ahead and go for something that's a whole lot, with a longer term time frame. How can the Fed react in the current situation? Well, first off, quantitative tightening probably they can probably stop that. That's the easiest option. I'm not saying they'll have to restart QE. They could do that, but at the very least, quantitative tightening ending. And then the other matter is, you've got some bonds in the system that have defaulted on. So it's a bit difficult for banks, because a lot of times they use it as collateral either with each other, raising money and so on and so forth. The Fed could say, okay, you know what, those bonds, even though they've been defaulted on, you can come to us at the discount window and use it as collateral to take liquidity. And that kind of eases the pain a little bit. So the banks can say, okay, between each other, we don't have to use these bonds, or maybe it's more acceptable to use it now because at the very least, worst case scenario, you can go to the Fed and you can go out and tap into them. And the third thing, of course, they could just entirely remove it from the market. They could say, okay, we'll buy up those bonds that are maturing right now, or trade them, they could shift things around a little bit just to take it out of the system. So the markets don't have to price anymore that they're holding on to something that isn't that you can't use as collateral, you potentially can't use as collateral, and that has defaulted on that it's reached maturity and they're not able to get their money. But just going to IG's trading platform, taking a look at the market for now. So far, stock market relatively calm. It's been great for the that's the US Tech 100 or Nasdaq 100. It's been great for tech. Part of it has to do with AI and investor flows that have been relatively consistent when it comes to the tech sector. We can talk about that some other time. And finally, want to point out that if you do want to read more about these items, the link is in the video in the description. You'll see that this week's weekly market report, not just when it comes to the week ahead, but also when it comes to a number of products: euro, pound, yen, Australian dollar, gold, oil, and the key indices, as well as Bitcoin, for those of you that trade crypto. With that in mind, I want to thank you guys so much for watching today. See you until next time. Happy ticks.